No worries. We're going to keep it short because I think we're running a little bit over. But I just wanted to start by thanking everybody online and our presenters today. I think it's been a really informative synopsis of, the different ways that we can manage risk on farm. We've got Peter O'Reilly here, who is the CEO of the Queensland College of Wine Tourism. And I'm actually going to put him on the spot and go to you first, if you don't mind, Peter. I'm going to ask, if you wouldn't mind, could you speak to, I guess, the importance of businesses managing their risk, particularly agricultural businesses in a community like Stanthorpe, that, a lot of the businesses in this community are agriculturally based. And the impact that, something like the most recent drought has on a community like this.
Yeah, look, there's no doubt, I think it was underlined for this community. There's enormous horticultural investment up here, in horticultural industry up here that drives so much of the local economy. There are other elements, and we're heavily involved in tourism and wine. But it's those agricultural pursuits that really are driving the area. 2019 was a real eye-opener for us, I think. We were lucky we got pretty good information, and you could see that one coming, and to contrast this latest El Nino, which fizzer or something, I don't know what happened, but the 2019 one, we got good information. And I think we were able, as a community, certainly, I think that cultural community did pretty well, probably better than the community of Stanthorpe. Like, we were talking earlier in the day, there was an enormous effort went into trucking water into the town. They had 44 semi-trailer loads of water past this door every day for just over 15 months, and it came a long way from down near Warwick. But I think the agricultural industry, we did it tough, and there were obviously no crops taken off note. There were a few veggie growers who really went out of their way to invest heavily in buying water, and that worked to an extent, although I note that not all of them survived as a result, perhaps of that. But those of us with long-term crops, so tree and vine crops, were able to survive the drought. I know I've got a vineyard at home, and I sort of took on a strategy. I was very fortunate. I got a frost that wiped out all of the Shiraz flowers, and you not usually think that November frosts are fortunate. But then when we looked at what was about to happen, we went through and green pruned in December and took off 80% of our canopy cover. And all of a sudden our transpiration went to 20% of what it would have been. And we didn't lose a vine. And I think there are a lot of apple growers who tried similar sort of things by saying, well, yeah, we had to take the hit this year, knowing that we want our trees there for the next year. And so there were quite contrasting strategies between the veggie growers who threw money at water and those with the permanent crops who went, well, we're just going to sit this out.
Yeah, thanks for that. And I think that, I guess, goes to the discussion we've been having today about the applicability of parametrics for different industries, right? The way you structure a parametric product for a tree crop that, you might be, ensuring the harvest versus, a tomato grower that's ensuring their crop or their entire crop. Russ, you were talking about, you mentioned co-ops up there before. We see farmer co-ops in other, like you said, in other parts of the industry of various sizes. How many farms sort of is the pinch point for a mutual?
There isn't any really. Beck, it's probably the answer. The more
one?
better. Yeah. One, yes. probably would take a conventional insurance if you was looking one only, because you need that sort of structure, to that mutual type structure, to have more than one.
Yeah.
But you could have, say, an example I gave you could be 8, and they'd be paying $250,000 each to participate in that 2 million, let's say. That'd only cover their 8 properties. So they probably wouldn't be too keen on paying $250,000 for a wider cover. So to answer the question is the broader, the more, the better, because you obviously are aiming to reach that sort of aggregated amount and keep the cost down.
And
so
is 2 million the kind of minimum amount, or could you have, say, 500,000 in that?
You could. It depends on what type of risk you're insuring, because it's value in it when you look at the reinsurers, what they're going to prepare to come down to sit above in the cover. So $500,000 mightn't be enough in a cyclone sort of area to say they're prepared to come. In other words, they're not going to charge you any less in their premium if they're only got an aggregate deductible, as we call it, of 500,000 sitting below them. If they've only got a small number participating, they could. So the answer to that question is it just varies. It just depends what sort of comfortable level you can get the optimum premium return from buying that reinsurance. That's an expensive component, as you would imagine. So the bigger you can get, more participation, the less you're going to need. If that 2 became 10 million, for example, well, they'd be thinking, well, there's not a lot of exposure above 10 million. We'll feel a lot more comfortable participating in that sort of level of cover.
Yeah.
So from 2 upwards.
Upwards. All right.
Yeah.
All right. Andrew, if everyone can cast their mind back to your earlier presentation, there were quite a few different drivers that you had in those slides, and often one of the pieces of feedback that we get from farmers is there's so many bits of information that I have to take on board every day in my business. I don't know what to take into account, what not to take into account. You hear one thing from one person and one thing from another. So what would be your advice to farming businesses around what are the key pieces of information or sources of information that, they should be paying attention to?
Well, I guess in economic terms, so just economic wise, look, it's lots of banks will have lots of different data. So again, it's available, so you can go and get really specific sort of data if you need it. And again, it's getting better every day of the week pretty much, because banks and outside of banks, all corporations have got access to more data to be able to then aggregate and come up with some trends. So if you're just watching the news, it can sometimes be a little bit more trying to be a bit more sensational. So but if you're looking at data, sometimes you have to pay for it, but generally speaking, you can find good access to good information and research.
And would most banks, business managers have access to that?
Absolutely.
So if you go and chat to your local business manager, they'll be able to point you in.
Yeah, exactly right. So again, it depends what you want. So you can get it from industry data through to markets data. I think where the banks in particular, I'm talking from our side of things, if you're looking at where it's going to go to, I think it's more around that sort of behaviour of the customers, which is a little bit more front-ended. So what I mean by that is that if you're looking at live data as opposed to the unemployment rate, which is sort of looking 3 months ago. So all that data is we can get very quickly, because people are using cards and everything that these days to pay for everything, and it's all being driven by data. So if we look at where it's going, again, we're going to have more live data, more quickly access it, and it's going to sort of provide us with a lot more information, I think, going forward. But yeah, I'd be definitely going through to local bank managers, people on the ground that are local will have information as well as local. There's a lot of broad stuff that's available through this.
Yeah, awesome. And I think, Jonathan, that data piece is something that's been really evident in all the conversations we've had today. As we're discussing earlier, when we first started talking about parametrics, and Russ, you gave the example of the cat in the box with the cyclone insurance. That was kind of for parametrics, it was, did this event occur? Yes, no, blah. Now it's a lot more nuanced because we've got a lot more access to a lot more rich data. Jonathan, if a business is looking to adjust their planting or harvest schedule sort of based on that data, in the face of climate change, can you go into a bit more sort of detail about what the role insurance sort of plays in that space?
Yeah, look, it's all part of Beck. It's all part of what we call InsurTech. It's technology.
So the ag tech for insurance.
But exact tech for insurance, yeah, absolutely. Technology, and then it's all about growers understanding the data. We all look at NDVI. We all look at the subsoil moistures. We all look at the weather, the rain, the heat. We know the consequences of these events. Can we trust the data? And to me, that's the most important thing. And I guess it's sort of saying, well, look at the correlation between the data that you've got and also the data the farmer has, the data that's being provided to settle contracts. And if you have that and you can see that all, and I put a slide up where we had a farmer's precipitation and we had the bomb's precipitation, and then we get them married. We can correlate it quite nicely. And if we correlate it, well, then it makes sense for an insurance product to be wrapped around it. So because data, being comfortable with the data and what that data tells, it tells a story. We take 100 years worth of data and you get a sense of what's happening to the climate in one particular area, 1 5 by 5 kilometres square. You get 100 years worth of data and say, oh, that was a bad year. That was a good year. I remember, 1992 or 1988. Yes, that was a bad year. Oh, I can see the correlation.
And then you look at says my climate view graph and you go, oh my God, what's it going to look like in 10, 15 years? So then, I guess you marry those bits of data together as well. So it's telling the story for your business.
It's telling the story for your business and how the weather impacts your business and then how you can sort of design an insurance product around it.
Perfect. All right. Well, has anybody got any in the room? Any questions? I don't think there's any more online.
Yeah, good question for John. Why is parametric insurance kind of considered expensive in the industry?
Yeah, okay. Look, generally when you look at a normal insurance where someone's prepared to pay, 3 through to 6%, it could be a farm insurance package. Parametrics are perceived to be expensive because we actually sort of look at the insurance product that we think makes sense. If you have a farm machinery insurance, what are the chances that it's going to burn down in the fire, or you're going to have issues with it? Those probabilities are right out there, but with the parametric product, we can actually see it's perceived expensive because we look at something that makes sense. We can design a product that basically says, well, if it's a 1 in 10 year event, it's going to cost you 10%. If it's going to be something that happens once in 50 years, it's going to be a lot less. So you just it's really up to the insured to say, well, look, okay, what type of event am I actually going to try and hedge against? And what's the probability of that event actually going to happen? Because that'll dictate the premium.
And the other thing, you can choose your limit as well there, Tim. Like $100,000. Let's say it's a 1 in 20, the premium's 5%, say. But if you're looking at comparing it with the property insurance, the whole property value might be $1 million for whole cover. And just could still be paying the same 5%. But you only, unless it's a total loss, you'll only get a partial payment when you pay out. With the 100 grand cover that you have with the parametric, it's the full payout. The event occurs, you paid out the full amount, irrespective of that damage that's occurred. It's agreed with the policy you're paid out. So there's the advantages of that as well.
And if I'm a business that has multiple income streams, not just agriculture, does that matter? If I have agritourism,
No, it doesn't matter.
Does that matter?
No, it doesn't. It doesn't. When you look at a parametric, it does. And back to Russ's point, which was a good point, the policies are designed so that we can see that it's paid out in full before. So we actually can see that, okay, you're paying for something, but we know that policy's paid out before. But back to your question, Beck, it doesn't really matter. You don't nominate, what crop you've got. It could be, and we did a cover once, it might sound a bit silly. We did a cover for Hungry Jacks at Bondi, parametric cover, because he actually said, well, look, if it rains over summer, for the first 2 weeks, that represents 60% of my income for the year. So he said, okay, I can't have it rain. So it's really how you decide it. We choose agriculture because that's our bent and we like it. But you can actually choose anything, any form of risk that you want to cover.
And it can supplement your payout for your farm loss as well. I mean, you might have enough cover under your conventional insurance, but it doesn't have to relate to the crop part component at all. 100 grand could supplement what you didn't get paid out on your property chapter.
So we're not talking about replacing everyone's farm pack, are we? We're talking about, them playing side by
The
side.
money is reused, and then what you didn't get somewhere else, you can use it for whatever purpose you wish. That's the point, you pay out.
Very good.
Yeah.
All right. Well, unless anybody else has got any questions, we might draw it to a close there. Thank you very much to all our speakers and everyone who joined us online.